Hi, Gary. Welcome to the Buy, Grow, Sell podcast.
Thank you for having me, Simon.
My pleasure indeed. Appreciate you making the time to come on and share your story and talk to us a little bit about, what you're doing in your business. And, I think, I'm really keen to unpack the story that, around how you've grown the sort of business. I don't want to say the word empire. It sounds a little bit sort of, a bit odd, but it's sort of, you've got so many businesses that you're involved in. It's just it sounds like a fascinating story. So, Gary, just for the audience, obviously the first time they're going to be hearing from you, but, one of your core businesses is RealDefense that's involved in cyber, which, geez, you can't get a more topical industry issue to discuss these days. But maybe you could kick off with a little bit of an introduction for us all and just a little bit of your background and kind of what led to you sort of starting that business.
Sure. My background is in direct response advertising. So I started an agency in the late 90s, right as the internet was evolving, and was one of the first performance marketing companies in the United States. Our clients were lots of Silicon Valley venture-backed startups to established companies like Disney, Sony, Wells Fargo Bank. And in 2003, I realized that it was time to sort of migrate to something bigger, and better opportunities that came around. And I sold my interest in my marketing company, and I started a company called CyberDefender. And CyberDefender was a consumer privacy and security company, mostly focused on security. And we went public on NASDAQ. Company was growing really fast, so we were profitable year one, grew revenues to about $100 million. And then in 2011, I left the company. I went to help a friend in Silicon Valley with a company called Anchor Free. It's a biggest VPN company in the world, 650 million users. Raised $60 million from Goldman Sachs, ultimately sold the company to another security company. And then in 2015, I co-founded a company called Incast, a influencer marketing company. And one of our biggest clients was ByteDance, which you can imagine who that is, the people behind TikTok. And we ended up bringing them to the United States. And that was pretty exciting opportunity as well. And so my background is marketing, customer acquisition, and cybersecurity. Those are two areas that I know really well. I'm also on the boards, an investor in different companies, ranging from crypto to healthcare. And so I have a diverse background in business operations, raising capital, raised close to $1 billion in working capital through my career, and understand all facets of an organization from formation to exit.
It's and hence why you're a brilliant guest on this show, because we talk about buying, growing, selling companies. I mean, it's very much a cycle. We see that some people only do one round on the merry-go-round, others do it many, many, many times. And so, I love the fact that you're able to kind of speak from those different perspectives. Can I ask a question? I mean, look, for a guy who's clearly entrepreneurial and you've had enormous success in a lot of ventures, where do you think that kind of entrepreneurial spirit comes from? I mean, were your parents in business for themselves, or like what was your early sort of view on being a business owner?
Yeah, it's a good question. My dad was a research scientist, so it has nothing to do with business at all. And my mom was a principal of a school, so very contrary sort of views to entrepreneurship and business ownership. I think it had to do with more just being exploratory in nature and curious. In terms of my personality, I just like to discover and explore. And also like the monetary compensation and the freedoms that comes along with it. And so it's not just about acquiring assets, but it's about having the ability to do things that you want to do when you want to do them. And so you can't do that when you're employed. And business, it's not just about earning and then keeping and then buying something expensive. That's not why you should be in business. And so I've learned that over time. It's not something you learn right away, but those are the reasons. It's not something in my DNA. In fact, nothing in my DNA says I should be a business owner. It's the opposite. I probably go to school and get a PhD and work for some research lab. That's in my DNA.
Yeah. But what, you did make a comment before about being curious in nature, and clearly your father is somebody who's into research. I mean, I think that curious mind obviously drives that desire to research and learn, and clearly that part of it has been handed to you or transferred over to you as well. How important is that curious mind, though? I mean, it's not just about going into business, right? I mean, even every single business day, business problems. Business to me is constantly about solving problems with limited resources.
Yeah.
It strikes me that you need a curious mind to explore that, right?
I think you have to always ask a question of why you're doing something, not how, but why. Ask the why first, and then ask the how. And a lot of business owners do the opposite. And so if you listen to a lot of people talk about a new venture that they're starting or a new business idea that they have, they engage in conversation about execution first. They talk about, well, I'm going to call an attorney, and then I'm going to get a patent filed, and I'm going to be the first one to do it, when in fact 100 other people have thought about the same idea at the same time. And so there's this conversation about like how to do it instead of talking about why you're doing it. The why you're doing it could be the reasons we just talked about, which is being an entrepreneur, being a business owner. But after you've answered yes to that question, and hopefully it's a yes and not a maybe, is that what are you gonna like? Why are you doing the business you're doing? Why are you opening up a restaurant? Why are you opening up a SaaS company? And so answer that question first, and then you'll see the path on how to get there, right? It sounds simple and trivial, but it's not. It's actually the hardest question to answer. I've always asked, no matter what I do in business, no matter what project that my team takes on and whatever company we're buying, it's always, why are we doing it? And if the answer is not clear, then we're not going to do
it. It's an interesting concept, I think. This, and for what it's worth, I mean, I agree with you. The why is actually the fuel that drives you through the challenges you inevitably will have in business. But I'm curious in your perspective on this. I've chatted to a lot of business owners over the years, and not every business owner has this fundamental, deep, purposeful why. I'm here to change the world. I'm here to do this sort of stuff. Sometimes that why is simply, I can see an opportunity. I think this would be fun. I'm kind of, and I guess I'm curious in your own circumstances, like, when you're tapping your why for the different ventures you go into, do you see that why being on a broad spectrum, or is there always this sort of deep, fundamental, values-based why that you look for?
Well, I think you're not going to particularly. Most individuals are not going to change the world. They can impact the world, but not change it. I think it's naive to believe that you can in most instances, and in very few instances that you could do it. It requires significant amount of resources and luck and consequence and relationships, and all those things have to come together at the same time to form this momentum that it requires for you to have. And most people don't even know, when they do get to that point and we do have the right resources and opportunities, don't know what to do with it. Elon Musk is a perfect example of that. Look at this. This is one of the few people in the world that has everything, resources, know-how, technology, capital, contacts, and he chooses to use it, sometimes in the wrong way and to his own detriment and to the detriment of people around him, right? And so I think you got to bring it down to like a more sort of palatable level, and ask yourself those questions, and not so be preoccupied with the big picture of helping the world, but incrementally changing your circumstances, for example, right? Your family circumstances, your friends, your colleagues, your employees, right? And so if you just get good at that, the rest is going to be much easier for you to comprehend and deal with. If you're focused on this massive undertaking, like how to move a mountain, how to change, healthcare in the world, and like these big things, and they're so big that you can't wrap your head around it, and then you're focused on the wrong directive because you're trying to figure something really big out. And I think there's been a movement around the world where entrepreneurship is driven in that direction, and I think it's misleading to entrepreneurs, and they get these big ideas and they don't know how to execute against them, and they just get stuck in this mud where they're just moving really slow, not being driven in the right direction. And so I would stay away from that. I would say don't worry about that until it becomes obvious to you. If
Yeah.
you've gotten to some level of success and you have capital saved and you're in your 50s, hopefully, because you've accomplished a lot already in life, personal life and financial life, or maybe you're younger, hopefully, then sit down and think about how you want to impact the world. Do you want to
Yeah.
go to Ukraine and fight in the war, or do you want to build satellite systems that protect people against weather movements that could be deadly, right? That's
Yeah.
impactful, and figure that out, right? But do that when you're later, more accomplished.
Yeah, look, I love the idea, and I think it's great advice of having a focus that you can get your arms or your mind around initially, right? I think like everything, it's big goals are achieved by chunking them down into manageable parts, and it's my son was recently in hospital and recovering from an operation, and I was explaining to him that to try to climb the mountain, you can't just look at the peak because that will overwhelm you. You just need to look at it in manageable pieces. So at the moment, it's for you. I said it's day by day, and during that day, like you don't climb straight up a mountain. There's ups, and then you go down a little bit, and it goes up a bit more, and it's to try to make that progress. But if you can't see the end of your current run or stretch or where you're trying to get to, that's where the mind boggles and you become overwhelmed, and it's and people freeze. You can't execute, right? Because you don't know what to work on next.
Right. And a lot of people don't know how to multitask. And multitasking doesn't mean that you're doing a bunch of things at the same time. Multitasking means you're accomplishing a lot of things at the same time. And so busy work is not multitasking. And I think we have to sometimes pull back our activities and say, what's the priority? How do I prioritize my day? How do I prioritize my projects so that I'm not doing lots of things that are not being productive at the same time.
Yeah, yeah. You remind me of a good friend of mine, John. He's he said to me so many times, if you have 50 priorities, you have no priorities. So, what are the top 3 things you're going to work on, or preferably top 1 or 2 maybe. But yeah, like how do you narrow down the focus into the more valuable items? I think makes a lot of sense.
Yeah, and actually in business, that's really important. I see in management teams and the boards that I'm on, this constant battle for priorities, and it's some nice priorities between teams within the company, priorities for a company in terms of its, is it revenue, is it profit, is it resources, is it product, like where do we spend our time, and everything has to be quantified if it needs to be prioritized. If it can't be quantified, it should be prioritized, right? Because if you don't know what the effort is, you don't know what the outcome is going to be, or if it's economic or some other, then it's not a priority.
Yeah.
And it seems simple, but it's actually not, because a lot of business owners, management teams don't know how to get to that level of thinking. Everything is a priority to them.
Yeah, it's interesting you say that, because once again, over the years I've dealt with so many different businesses and business owners, or predominantly private businesses, and the amount of times, even good companies, they turning over 20, 30, 40, 50 million, and we've gone in there and seen that they don't have any kind of plan with measurable outcomes. There's no dashboard or balanced scorecard, whatever tool you want to use. I don't really care, as long as you've defined specifically what you're trying to achieve and you've been able to break it down into some high level measurable goals. And it just fascinates me how often I see businesses running that have no direction around that stuff.
Right.
And I think many of them family run businesses too. They're just kind of in the rhythm of, this is kind of how we do things around here, and they just lack that focus.
Right. Well, it's you can't expect that sometimes with newly minted business owners, right? Especially if they're in tech, and they've never had the experience. So you have someone in their 20s, they move to Silicon Valley, raise some money, or any big city for that matter, and suddenly they're thrown into the pit, and they have to figure out the way how to build an enterprise. And so it's highly likely that they're not going to know how to do that. But if they have a good product, these things tend to solve themselves over time, because if you have a really good product, consumers will know that, or your customers will know that, and they'll pay you. And so all you're going to be focused on is how to make that product even better, how to protect against competition and how to create a bigger moat around yourself. And
Yeah.
I would rather focus on that. If I can have a business and all I got to focus on is my product because the sales are coming in organically, that's the holy grail to success. But unfortunately, that's not reality for 99% of the businesses out there. They have to spend money on advertising, marketing, public
Mm.
relations, sales infrastructure, and because sales don't come to them, organically.
Yeah.
So that model works good. We have a freemium or some sort of a free giveaway very well, but outside of that, it doesn't work.
Yeah. Yeah. I'm curious in your thoughts on something. For those listening to this, some of them may be running a business already or thinking about their next business. I'm curious. You touched on earlier about kind of what is the formula or the ingredients for success. And I think I've seen a lot of business owners who kind of fall into their business. Hey, I was good at architecture, so I eventually went and started my own architecture practice, or I'm good at building widgets, so now I do it for myself, or um, which strikes me as being more of the sort of bottom up kind of thinking. I'm already out there doing this, and therefore maybe I should keep doing more of it for myself. But so often, and I think you touched on it with your businesses, marketing and things like that, when the internet was taking off, you've gotten into cyber, which strikes me as these really big macro waves that are coming. And, I guess I'm interested in your perspective around what's the right blend here between my own personal skill sets and just seeing the market opportunity for what it is. Is there a blend there or an approach that you take?
Are you saying that how do you figure out which business to build, right?
Absolutely, yeah.
Yeah, there's lots of ways to think about it. I think there are the more riskier ways and less riskier ways, more conservative, and more liberal way to look at it. So uh, there are investors out there who prefer one or the other. I'm more on the conservative side. I used to be more on the risk taking side where I wanted to do something new, and I've given up that idea because I believe that I'm better at doing something that already works and making it better rather than starting something from scratch. That's just my view. Doesn't mean that you should
Yeah.
do that or anyone should do that. But if you were to sit down and say, okay, I've got a little bit of money, whether it's from friends or family, or I have saved it, or I sold the company, whatever, and I want to do something brand new, I would look at trends that are going on in your city, in your country, in the world, and understand those trends as they relate to an industry that trend is in, because most likely not a new industry. It's most likely inside of an industry, but it's becoming something is growing somewhere, right? And so I subscribe to some newsletters that give me that kind of data that tell me
Mhm.
where there's spikes in activity. That activity comes
Yep.
from Reddit. That activity comes from all kinds of different social media platforms where there's discussions about some subject matter. Obviously,
Mhm.
Google, you see search keywords, going up in certain categories, and you'll see that that's a trend. But also quantifying that trend. How does that relate to commercial activity? Because if someone's talking about a news item, that's not a commercial trend. That's just a popular subject matter for a very short period of time, and then they stop talking about it. But if there's a commercial trend, then you need to get on top of it and see if you can get something done in that category. But you should have a background in it. Like if you're seeing people buying and selling airplanes, jets, and you are from, you know, you're an architect, like that might not be your business, right? Don't think that you're going to be an expert in selling airplanes. And so um, focus on what you know. So if you're in the restaurant business and you're seeing some new micro trend happening in some food category, and you happen to understand food and dynamics of supply chain and how to make them profitable, by all means, jump into it and figure out a way how to build it. Investors like that. They want to see a continuity in your thinking. Like you're an expert, you went to school for something, and you became a business owner in that category, then you raising money in another business that's in the same category. So, it doesn't
Yeah.
mean that you can't do it. Like, did Elon Musk have experience building rocket ships when he was in high school? Probably not, right? But look what happened, right? So it really depends on your resources. If you're contributing a lot of your own capital, then the argument is anything is possible. Just invest your own money, and there you
Yeah.
have it. You have your company, right? So, but if you're looking at success, like measurement of success and what's likely to succeed and less likely to succeed, what I said first was it's more likely to succeed, and what I said last is less likely to succeed, right? So, derive your own conclusion. If you want to go take a lot of risk, go with the punches because it's going to be a lot of ups and downs. And if you have enough capital, if you have enough patience, then you can always get there. Okay.
Yeah.
Now, if you want to go populate the moon and you want to be the first citizen there, you want to build a ship that goes there, it allows you to live on the moon, you're going to have to wait a long time. If you want to build, something that allows others to do that, so maybe some kind of a component for space travel, then maybe it's more likely to happen in your lifetime. And so it just depends on the spectrum of time that you have to build it. And so the good news is that there's lots of data out there. Just do a little research on trends. There's a ton of information out there that gives you that. So, but definitely do research. I'm very skeptical of people that don't know, particularly when we make an investment into a company where the founders don't know their space, like they don't know the trends and don't know who the competition is. And when I see something that says like we have no competition, that's a problem, right? Because you're maybe doing something that nobody wants, or unless you've uncovered some gold mine somewhere, and that's unlikely in most cases. It's very unlikely.
Yeah.
So,
yeah. As an investor, Gary, I'm sure you must have seen this sort of stuff before. I know I've seen it plenty of times too. But where you see this would-be entrepreneur, a startup, they've got a new idea. Personally, I don't think there are any new ideas. I just think there's variations of old ideas,
right.
Personally. But at the end of the day, I see a lot of people who still go out there with this mentality of, if we build it, they will come.
Mm-hmm.
If we just build the product, man, it's going to be great. Do you have any thoughts about that approach?
Well, again, it depends on what area of what industry you're in and how do you create demand. And so demand creation is extremely difficult in every business, any category. Where there's no demand and you're creating demand, right? And so we have, in my company, we've had a few products where we would go to partners and would say, why don't you resell our product? And our partners would say, well, there's no demand for your product. The answer to that is, we're going to help you create demand, and here's how. And we illustrate the process, right? We show them with numbers and bunch of like supporting documentation. But that's because we have experience doing it.
Well, I was going to say, and I mean, I think in that example, you're already selling this product to somebody else. You have proven that there is demand or there's a need, and the market has responded to it. It's, I find too many people, and I've seen too many presentations where people are pitching investors for money and saying, listen, I know this is different. It's a completely different. There's nothing like it out there. Maybe that's the case. And if we just build it, and we throw some marketing at this, people are going to come. They're going to want to buy this, and it's. I personally, as an investor and as somebody who's run a few different businesses, I always look at that and think you've lost me. If you're telling me you just need my money to throw it at marketing and try to find some customers, man, I'm out, because I want to see that people are already buying this. I want to see people that it's proven in the market. It's got some track record, that really what we're just doing is putting some fuel in an engine that's already running.
Right.
And so it's, I don't know if you see stuff like that, but
yeah, we do. And generally we won't invest into a new venture like that. That's not our business. We invest into ventures that have been in existence and have a track record of profitability. But if you're a venture capitalist, or if you're an angel investor and someone comes to you with such ideas, you got to really think it through. You sometimes crazy ideas work. Who's to say that someone's crazy device that's supposed to do whatever isn't the next big thing, right? Unless you can predict the future, and none of us can do that. And so you have to look at that with that kind of a point of perspective. But the founders also can look at it and say, if this didn't work out, this venture, we can always pivot, and we could pivot towards this. And if we pivoted here, we know there's a market here and we can be successful doing this. So we're not going to lose your money. We're going to go for the moonshot idea, and we're going to
Yeah.
execute, and we have all the right resources, the right infrastructure, the right talent. But if it doesn't work, we're going to go this way, and we think this could work also, and this could work also. And if they created that kind of a roadmap, I think investors could feel comfortable that they're not throwing the money away. But there are
Yeah.
funds out there. There are investors that are in venture capital space who only invest into big, crazy ideas.
Yeah.
They
Yeah.
like the stuff. You go to them and you say, I'm going to build a bridge from here to Mars, and we're going to have cars going back and forth. And they'll give you money because they think that you have a new metal that you've created that can withstand that kind of distance. It sounds crazy, but there are people talking about this kind of stuff. There are people talking about building a lift that goes from here to the moon. This has been a discussion for 20, 30 years of companies coming up with plans, architects actually drawing the stuff out and showing how it can be done. And there are financiers who are putting money into this kind of stuff. It's not crazy, it's reality. So you can do it. I just, I wouldn't do it. I would, because I don't know how to do it. And so I would stick to things that I know how to do and make money from it.
Yeah, fair enough. Coming back to the sort of practical side, I guess, of growing a business. I mean, you've grown businesses organically. You've done numerous acquisitions. Have you got much thoughts around this concept of build versus buy, or grow organically versus acquisitions?
Sure, absolutely. In fact, I would say that if you're a business doing $5-10 million in revenue and you are in the category where customer acquisition is expensive, and I would say more than $100, you're going to benefit more by buying a business than getting that same customer through direct response marketing or some other marketing channel. And the reason is multiple fold. One is that there's a lot of risk investing into marketing when your customer acquisition costs are high on a per unit basis. So if it doesn't work out, the money's lost, right? You're not going to go back to the advertising platform and say, "Oh, I want my money back because your ads didn't convert." That doesn't work. So, so that's number one. Number two is that your time that it takes to get to the same level of scale. So if you want to double your business, that can take you 5 years, 10 years if you're not financed and you're doing it organically. If you buy a business, you can have that same growth within months after acquisition. You can have financing from a partner, from a financing partner, a bank or an institution, much faster for an acquisition than you would get for growth capital. It's much easier to get that financing because banks that finance this or financial institutions that finance acquisitions can quantify the return on their capital much easier with an acquisition than they would if you were just to raise growth money. And so, and then you're gaining staff and technology and resources. You're getting synergies from that. If you have too many people that do the same thing, you downsize. If you have technology infrastructure that's doing the same thing with two companies, you get rid of it because you don't need it. Your profitability goes up. Your reach expands. You can cross market to each other's customer bases. Like there's numerous benefits, synergies that creative revenue profitability. So.
Yeah, no, that's cool. What would you say to the business owners out there, though, that they're saying to themselves right now, hearing this, "Oh, look, but I've never done a transaction. I don't know how to do it." Surely, that they see the unknown as being quite risky themselves.
Well, if you don't feel comfortable doing it, don't do it. Okay, that's the first advice I would tell you. The second is hire a professional that understands mergers and acquisitions, not a friend who has done one deal before or some attorney who says they know how to do the legal documents. That's not, you need an M&A advisor, a professional firm that has lawyers, accountants, all the resources you need to bring to the table and understands how to negotiate these types of deals, has done a lot of them, maybe hundreds under their belt, and knows the nuances related to an acquisition. There's so many. There are hundreds of ways to get ripped off, hundreds of ways not to close, hundreds of ways to lose money and then get sued or end up suing someone else. You'd be amazed how often this happens. Like 15, 20% of all M&A transactions end up in a lawsuit. So you got to be really careful and don't do it if you're not comfortable doing it. If you think it's too risky and you're afraid that something's going to go wrong, just don't do it and wait till the moment when you're not afraid of these things. And so it's not for everyone.
Yeah, I think that's great advice. It's and like anything, like you said before, it's about having the people around you. If you're about to face a big walk through the jungle and there's all sorts of scary things in there and you've never been there before, of course you're going to be terrified. But if you've got a guide who knows the track and knows every branch to duck under and every pothole to step over, it becomes a lot easier when somebody can guide you through it and point out the risks and help you mitigate them, right?
Right, and that's like that with anything. You're any kind of venture you step into, you've got some kind of guardrails around you to get you through it. But M&A is fairly complex, and no matter how big the deal, if you're buying a
Yeah,
$200,000 business or $200 million business, same thing in terms of due diligence and risks involved, and you're buying someone
yeah,
else's assets. You don't know how they got there. You don't know them if you know them personally, and so I try to
yeah,
do business in our M&A environment. I try to do business only with people that I already know and have an existing
yeah,
relationship with from the past, like 10 years ago, 15 years ago. And I know the companies are real, that their assets are real, that the management teams are real, investors are real. And I try to buy companies that are carve outs from larger companies. So you got
yeah,
$1 billion business that wants to sell a $10 million business. Those deals are less riskier because a big company with lots of lawyers has looked at this asset and said, everything's okay, we can sell it. And they don't want to get sued, so they'll protect
yeah,
themselves, right? And so you want
yeah,
that ideally. Have a lot of friends in the industry, research your space. If you're, a car dealer, talk to other car dealer owners and see what they're doing. And maybe they're exiting and they're retiring or moving or whatever the circumstances are. And you want
yeah,
to be
yeah.
right there when that asset becomes available for sale and not let them go and hire a broker and start looking for buyers, because then you're paying market value. And
Yeah,
so
yeah,
it's important to have relationships and constantly be looking out there and talking to people.
yeah. Finger on the pulse, right? It's a good point. I'm curious in your perspective here. Once again, you're doing acquisitions out there, and you've done certainly a number of them. So, um, in my experience, I've found there's buyers at all different levels, and I might have a 10 million turnover company, and then you're talking to some listed entity sometimes, and I'll just say, look, we like the business, but it's just too small for us. It's kind of in some ways just not worth doing the
Right.
transaction after we do all the cost and the time and the blah 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 blah. So I'm curious, do you have particular thresholds that maybe use as a bit of a guideline for yourself when you're looking at opportunities?
Absolutely. So we for our businesses, it's at least $1 million, $1.5 million in 12 months trailing EBITDA or profit,
Yep.
or higher. So up to 20
Yep.
million in EBITDA. Uh, if it's smaller than that, it creates all kinds of complexities for us in terms of due diligence and
Yeah.
process we have to go through. And unless there's some real underlying asset there, like customer base that's not monetized, or technology that's not monetized, or some unique intellectual property that's not being given to the market the right opportunity, or doesn't have the scalability, there has to be something special. But if you're looking at it from like just a high level 50,000 foot view, you are more likely to find a better deal that's worth more in terms of like top line revenue and profit than you are a
Yep.
smaller company. Because a small company
Yeah.
has lots of risks associated with it. I'll give you one example. If the company does less than $1 million in profit a year, chances are those numbers are adjusted without CEO pay. So they take out the CEO pay and they go, here's $1 million. How much is the
Yeah.
CEO earning? Oh, $350,000. Well, that's your real cost, right? So 1 million minus 350,000, that's your real
Yep.
profit, because you
Yeah.
need to hire someone to run that business, right? And so a lot of people don't understand that. And they go, oh, it's $1 million profit business. And I don't, no, it's not.
Yeah. Yeah. Yeah, you're spot on. I know I've seen that sort of stuff all the time out there. I'm constantly having these discussions with business owners, often because they've been told by some other advisor, oh, yeah, we can do this and bump up your numbers. And I
Yeah,
keep saying to them, guys, acquirers aren't stupid people. They're usually quite smart people, and they have very smart advisors. And by simply even trying that on, all you've done is basically paint yourself as somebody who's trying to get cute around the edges and play with the numbers. Like, I have this bit of a saying that, deals only get done when you've got a willing buyer, a willing seller who can form a lot of trust in a short period of time.
right.
And when you play around with numbers and get cute, the first thing you've just done is undermine trust. And so, it's hard to explain that to people when they're thinking about, I've only got one shot at selling my business and I want to get as much money as I possibly can.
Right. No, it's absolutely true. There's not, if you're dealing with a sophisticated buyer, they'll see through it. And it's also about being transparent. The faster you get to a point of full transparency, the faster you'll get a buyer who's willing to pay for it. Because there's nothing, if they don't feel like they're being manipulated and they can see through all the numbers, then they're likely to continue talking to you and working with you. And ultimately, you don't want to be in a position where you get sued. Like the problem with M&A is that even if you get through the sales process, you sold your company, and you've masqueraded, the infrastructure or your financials, eventually they're going to come to light, and you don't want to be in that situation. There's lots of stories like that with HP, Dell. They've done a lot of deals like that for lots of money, for billions of dollars, where the revenues and profits just weren't there. They were masqueraded and not told the truth. So you might be careful.
Yeah, absolutely. Yeah, as you said, it's if you're not found out later, that's what directors' warranties and indemnities are for, right? So you're not just off the hook. If you've done something dishonest or a bit dodgy, you do get found out. And in fact, I'm always saying to clients out there too, or anybody who'll listen, quite frankly, is that pretty much everything comes out in due diligence. My last guest, we were just talking about the analogy of feeling like an onion, that you just get peeled layer by layer by layer until everything is on the table. And deals are won and lost in due diligence, of course. But I'm curious, have you in your travels and looking at deals, have you had many deals where you've kind of gotten into that DD phase and then eventually said, hey, I'm out, this is not what we thought it was?
Well, I had some interesting scenarios, not quite like that, but actually to the benefit of the target company we were trying to buy. So we had a deal we struck with a seller, and we went to see the company, and everything checked out. It was great. The company did not misrepresent anything. Had a great profile. The financials looked perfect. It was great. But the day we were supposed to meet to sign asset purchase agreements, we get a phone call or text message like 4:00 in the morning saying the deal is off with no explanation as to why. And so we started looking underneath researching as to what happened. We learned that during the due diligence process, we inadvertently told them what we're going to do with the business. So they asked us, what are you going to do once you buy the company? We said, we're going to do this and this and this and this. And they said, how? Why aren't we doing that? Why? We don't need you to do it for us. We're just going to do it ourselves. And so these guys went out and they did exactly what we said we were going to do. And so they implemented it, and now they're a bigger success than they were before we bought them. And so it's okay. We spent money on legal fees, and they ended up covering those, so we're not out of pocket on anything. We had that provision in our contract. Okay. But it was a telling moment where we told ourselves and our team, no more these consultative engagements where we say, oh, this is how we're going to improve your business after we buy it. You keep your mouth shut and get the deal done, and then go tell them what you're going to do, because now you own the company. And so you got to be
information
really
is power, right?
Yeah, it's just live and learn. But generally, we only engage in companies that we have a very good understanding of their business. We probably have a relationship with them in the past. We've done business with them, or they're a vendor of ours of some sort. So we do a lot of diligence. There's one instance where I could say that we jumped out because we didn't like some of the numbers, and we dug into them, and we said, you know what, these numbers are not sustainable. Companies spending too much money in advertising, and there's some negative cash flow that's being masqueraded a little bit with shared expenses from the parent company. And so that's also, you have to be something really careful about. The parent company can say, oh, my accountant spends 2% of their time in this small division, when in fact they're spending 90% of their time in that division. So you got to hire an accountant. Well, that's going to cost you $120,000 a year. And so those scenarios you got to be really careful about. But generally, if you're dealing with a professional company that's run by a management team, and hopefully there's some institutional investors behind them, you should be okay. If you do your due diligence, you're going to come out just fine at the end.
Yeah.
Most people don't lie.
Cool.
So. Most people are honest, and
Yep.
most people don't hide things and don't try to
Yeah.
manipulate. Like 95% of people out there.
Yeah. Yeah. No, it's a good point. I think sometimes in transactions, certainly at the smaller levels, when you've got business owners and maybe another private investor, they're not, people are often those type of buyers. They're buying their next venture. It's quite personal to them, even. And I think it can be hard for sometimes people to step back and just understand they're all human beings. Everybody's, like, let's lower the emotions a little bit. They're not trying to screw you, or there's nobody evil on the other side. Everyone just has their own perspective. And it's the communication that helps get through those things and understand where everybody's sitting and where you need to go.
Yeah, yeah. It's you have to find cadence with the target company or whoever you're merging with or whoever you're doing business with, and you got to feel that they understand you and you understand them. And ultimately, if you're merging assets where you have a company that has employees and those employees are going to come work for you, you want that to be
Mm.
a very smooth transition. And as much as businesses would like that to happen, a lot of times that doesn't work. Sometimes cultures clash, and it could be just the management style of the management team. It could be the prioritization that the company makes in terms of the product execution, how they do things. And you got to really
Mm.
understand those nuances before you get a deal done. You got to go in there and talk to the employees. Like I actually talk to the engineers. I
Yep.
interview them because I want to know what's in their head.
Yep.
They may say, I don't want to build products like this anymore. I hate this category. I want to do something totally different. Okay,
Yeah.
then this is not a right match. Then we move
Yeah.
on.
Yeah.
And so you want to
Did
have
this-
that conversation.
Yeah, yeah. No, that makes a lot of sense. Let me ask you a little, I don't want to get too into the weeds here, but just a question. You talk about interviewing the engineers and stuff like that. Um, One of the things that I think every business owner is worried about when they go to sell their company is confidentiality, or, and kind of losing control of the process and the stream of information to their staff and their clients, et cetera, et cetera. Um, and so there's often this tension here where I find buyers would love to speak to management and speak to them as soon as possible, with as much detail as possible. And this resistance from business owners, not because they don't want to share information, but because they're trying not to lose control of the process and the information. And so I guess, how do you play that tension? I mean, how have you approached that in the past?
So, okay, that's a good question. So you want to manage as a seller. You want to understand your weakest point in your business. What if you lost X? What would happen, right? And so a lot of times that's a customer or some intellectual property. So if it's intellectual property, the best thing to do is don't show intellectual property until you are confident that that deal is going to get done. And you need to have your attorneys prepare very specific information, specific agreements that prior to seeing that intellectual property, like let's say it's code that you want to reveal, like the other side
Yep.
wants to review your code and understand what does this code do. Well, you need to make sure that that code is really unique, because if they look at the code and say, oh my God, this is the same as another company, but you just slightly changed one sentence here, that's not unique. Okay, so then you're not going to protect anything. But if you have something that's really unique, you want to write that into your asset purchase agreements, or into the at least the letter of intent, or some sort of a intellectual property protection document that says this specific area cannot be duplicated, and if it is, here's the penalty, how the penalty will be executed, and all that stuff specific to
Yeah.
that particular risk. But more importantly,
Yeah.
is not to share information at all that hasn't, it doesn't need to be shared until a point where you feel comfortable, confident that a deal is going to get done at the structure that you expect. Because a lot of
Yeah.
deals to get restructured during the process, you get one term sheet in the beginning, and then it gets retraded down. Valuation goes
Yep.
up, structure changes. Oh, we saw this. We don't think it's worth that much. That's almost 90% of the times what happens. And so,
Yeah.
seller beware of companies who retrade their offers. We don't do that, but a lot of companies do. And so That's a
Yeah.
risk. And then as a buyer, same thing. Are you being handed something that's not unique? And you know, what are you agreeing to? Are you agreeing to something that you already do, and this company happens to own some derivative of it, and they're going to claim that you
Yeah.
stole it from them? Like, you gotta be careful in those scenarios. So,
Yeah, I think that makes a lot of sense. I mean, I think your comment there, I think when with about the penalty clauses and things like that, I think a lot of regular business owners would be scared with that option because they say, yeah, okay, but they copied our stuff and they've run off with it. But to do anything about it, I need to sue them. I need to go through this process. It'll take years. It's going to be expensive. So they're trying to think, well, how can I avoid that in the first place? And I think, there are obviously some good mechanisms that people can use, particularly when you're talking about stuff like code. I think on a recent deal that we did, it was a SaaS company, and they basically, the vendors, our clients, had said, well, we're not showing you the code until the
right,
absolute last minute. It is the
right,
last thing we do. And fundamentally, we're going to explain stuff to you. We're going to talk you through our tech stack. We're going to talk to, give your tech guys enough information so they know what they're dealing with.
right,
But the code review doesn't come until we've literally agreed some terms, we've
right,
agreed broad prices. Yes, you have a get out of jail free, clause if you read the code and you think we've stolen it or something, we've done something wrong. But kind of it was that last minute, it's a black box until the deal is agreed
right,
fundamentally.
right.
Um, and do you see those sort of approaches being used in
Yeah.
deals as well?
Well, that's what I was saying earlier, is that you wait till last minute until you feel confident the deal's going to get done, and then you reveal your goods and say, here's what you're really buying.
Yeah.
So that is absolutely the right way to go. And you need to hold that. That's your last thing, right? That's your
Yeah.
that's your secret sauce, and you don't want that shown to anyone until you're 100% confident it's going to get done. And
Yeah,
do
for
your
sure.
diligence on the buyer. If it's a financial buyer, like a private equity firm, do they have a history of doing this to their target companies? Right?
Yep.
Research that. Go online, talk to. When we're buying a company, I always tell my target companies to call another company that we bought and talk to the management teams and the investors and ask them how we did. and
Yep.
and they need to feel comfortable that these guys are for real. They're not going to steal anything from me. They're not going to retrade their offer. And then they're more open to giving you information, because it's
Yeah.
also,
Yeah.
you have to have the reputation in the market that you don't do things like this. And
Yeah.
if you do have that reputation, it's going to catch up with you, and someone
Yeah.
is going to talk about it, and then no one's going to want to do business with you. And so,
Yeah. For sure.
you gotta be careful. Unfortunately, or fortunately, however you want to look at it, this space is not very well vetted. In other words, anyone can make an offer to buy a company, and you don't even know if they have money in the bank. And
Yeah.
so
Absolutely.
they could be raising money in the back of the transaction. They could be doing a reverse merger into a publicly traded shell. It could be an offshore fund that you're not supposed to be doing business with. Lots of players out there who pretend they're buyers, and they're not real buyers. And so
Yeah.
you got to weed them out and know who you're talking to. That's how
Yeah.
you get
No.
that's how you get ripped off. If you're talking to the wrong buyer, they can take you through the process and get all this intellectual property, and at the end of the day, they'll just decide to leave and say, I don't want to buy your company anymore because I got everything else. So
Yeah, absolutely. And I guess another reason to have a good deal team around you to help you with those perspectives and understand the risks. Another question I just kind of wanted to throw out there, without getting once again too technical or in the weeds here, but one of the big topics I think a lot of business owners hear about is earnouts in a deal structure. And I'm just curious about your perspective. Have you used them, seen them? Do you have a general view? Yeah.
yeah. So earnouts can come in different flavors. It can be based on performance of revenue, profitability, product launches, contracts, tenure, whatever you agree on.
Mm,
We tend not to do them because they're complicated, and they're a nuisance in negotiating process. Like for us,
yep.
now it's not for many other companies. A lot of companies like them. We
Yeah.
we tend to do it as an insurance against potential risks. And so we did a deal once where maybe 5% or 10% of the value was put in escrow. and it was paid out every quarter or every 6 months based on, I think it was related to the churn rate of the subscriber. So if the
Okay.
churn rate was above certain threshold, we said we're going to keep this money in the escrow account. If it was below it or above it, I don't remember what the terms are, then we would not. And so that gave us a little bit of insurance that we're getting a good deal. But it was not a big percentage of the total value of the business.
Yeah.
Um, you need to be, as a seller, you need to be concerned of whether or not you are in control of the outcome related to earning that earnout. So, for instance, a buyer says, I'm going to give you $10 million. Of that, $3 million is going to be an earnout for the next 3 years if you guys hit these metrics, like your revenue numbers. Well, you're not going to own the company after the transaction is completed. Who decides on the budget? Who decides on marketing spend? If they cut your marketing spend, your revenue is not going to hit. Then
Yep.
how are you going to earn your earnout? And so I think statistically, like 30 or 40% of earnouts are never earned in terms of M&A.
Yeah.
I don't know the exact number, but a big percentage is not earned because of those reasons.
Yeah, it's funny. A friend of mine who's an attorney, he said he was saying to me that 80% of all the court cases around M&A, in his experience, relate to earnouts.
Oh, yeah.
And it's the old thing. Oh, we're going to measure you on profit, yeah, but then right at the end of the financial year, we're going to hit you with a corporate charge that wipes out your EBIT.
Right. Exactly.
It's
Yeah.
all these sort of things that are quite kind of underhanded. I mean, look, and that's not to say all buyers are like that. I think this is back to your point. Do your homework on your buyers and see how they normally deal and trade and do business, because there are people out there who play those sort of games. But and I've had plenty of people, guests on this show, that have walked away from earnouts because they've just said this is toxic
Right.
and impossible. Having said that, though, I've had plenty of guests on here who've walked away saying, "Do you know what? Like, the relationship, I felt good with these guys. I felt like this was a good fit. They told me they were going to do X. They measured me on that, and it all got delivered, and I got my full earnout. It's
Right.
so I don't think I wouldn't want anyone to walk away from this, hearing this episode and thinking that there's a silver bullet or the one solution, because there's so many different ways to slice and dice a deal. You just got to
Right.
kind of work out all the different variables and what's right for you, I guess.
Well, the fundamental way to look at this is that if you're going to measure your business, let's say you have a SaaS company, you have recurring revenue, and you're growing year over year. Okay, you can if you can value this business based on its present value, meaning what it is worth today and what
Yep.
it will be worth a year from now, right? And let's
Yep.
say that your buyer is willing to pay you for both, but you should at least earn what it is worth today, and what it is worth in the future. That's your earnout. And if those
Yep.
numbers make sense to you as an individual, meaning you're not going to earn that money on your own anyway in the next 12 months, right? If you're being offered
Mm.
that kind of, that's a low valuation, and you shouldn't do that deal. But if they're giving you a lot of money that you would have not earned in the next, let's say, 5 to 10 years, that's probably a good deal. And then the earnout portion of the transaction is built on what it will be in the future. And if you can
Yeah.
attain these goals, right? So you're doing really well and you're going to continue to grow. So if you break it down this way, then you're more likely to have a good outcome. And if you don't earn that earnout for whatever reason, then you still had a good deal. You're not out of pocket. You're not losing. You're still going to win. And it's the risk of doing a deal like that. A lot of
Yeah.
buyers,
Yeah.
particularly, just real
Sorry.
quick, a lot of buyers in the financial buyers, what they do is they beef up the valuation with lots of tricky moves in terms of how they structure the value of the deal. And it looks like a good deal because the valuation is set really high. And when you start breaking it down, it really isn't. When you look at cash at closing, it's a much, much smaller number. And we
Yeah.
compete with that a lot because we go to a buyer and say, here's our offer. And they go, oh, I've got this other offer somewhere else. But when you ask them, what does that offer look like? And it's like 80% earn out and 20% cash at closing, right? And so,
Yeah. Yeah. It's not apples to comparing apples with apples, right? I think probably a piece of advice I'd be giving business owners here as well is that put yourself in the shoes of the buyer for a moment. Try to look at the deal from their perspective, and if you're making lots of speculative promises, I mean, earnouts are a risk mitigation tool. the more speculative your promises and how much you're sprouting the opportunity for the future that's not proven, well, the more they're going to question that and want to put some risk management tools around it, and the earnout just happens to be one of those tools that gets used fairly often.
Right. And I'll tell you, there's lots of options for sellers, owners of businesses to keep the equity of their company, not sell their company, and still take money out of their business. It's called dividend recap. And you go and borrow money against your company based on some ratio that the bank's willing to give you. It could be 2 times EBITDA or 3 times EBITDA. Pull that money out, put it in your pocket, pay your payment, your obligation, interest payments as you're supposed to, but keep your equity. If you believe your business is growing and you don't want to accept anything from a buyer that's south of some valuation you have in your mind, just don't sell. Borrow against the equity, against the asset, and then keep your equity. And a lot of business owners don't understand that's available to them. They don't need to sell their equity. In fact, I am against selling equity at any time. I think that you should always borrow and don't sell your equity.
Well, it's expensive, right? Equity's expensive. Debt's usually a lot cheaper. It's if you're looking to grow and build, and I think that makes a lot of sense. Gary, I'm cognizant of time here, and I appreciate how generous you've been with yours. Maybe I can just ask you one sort of last question. I think I'm certainly interested about. I'm sure our listeners will be too. You've started companies, you've gone out there and you've built them, and you've done the organic stuff, and you've obviously had success, and you've grown to a point now where you can acquire and other businesses and grow using a different model somewhat.
Right.
I'm kind of a little curious about your journey as the human, as the leader here, because I'd say the way you spent your time in those earlier businesses and the things you were doing each day is probably very different to how you spend your time today. And so I'm curious about what that journey was like for you, and were there any kind of real hurdles or it's clearly even a different set of skills, right? So I'm just curious about what your journey was like.
Yeah, you learn a lot in terms of managing people. One the biggest company I've had, that I've run had a couple thousand employees at one time, and so managing employees and dealing with human resources issue, it's a fairly involved undertaking as a CEO. And the one thing you need to learn as you evolve as a leader is how to not micromanage your management team, how to ask the right questions, meaning what do you want them to accomplish and why, as opposed to giving them incremental tasks and tell them how to accomplish those, the big task, right? Because if you're doing that, they're not managers, right? And you're not being a CEO. You're just doing their work for them. And so either get rid of them and do their work yourself, or hire people who are competent and know how to do what they've been asked to do, and give them KPIs that they have to hit. And so I've learned how to do that. And now that when I hire people for my companies and any transaction or acquisitions that we do, we only look for people that know how to take direction, that know how to execute, don't need micromanagement, and will come forward with information, as opposed to you asking them constantly what's going on and why is this not working. And if you're engaged in that type of management style, you have the wrong team and you're not asking the right questions. And so I've learned that, and I tell you, that's the most valuable thing I've learned is how to manage expectations, because it's the success and failure of every business. Full stop.
Brilliant.
If you don't know how to do that, bad things will happen to every company. I've had bad things happen. I had collapses and bankruptcies and financings that didn't go through, like all those things. You have to be able to talk about them and tell your investors why something is not working. If something failed, just say why, and let it out of your system. Because if you hide it and you try to play games, it's all going to come out at the end. So.
Yeah, it's great advice, isn't it? Because once again, it's back to this issue of almost like due diligence, and I was saying to our clients is you just need to be open and transparent and honest, but also, like in my experience, buyers don't expect you to have the perfect business. They actually expect that you've had problems, and so really what they're looking for is that you've got enough intellectual capacity, I guess, but enough foresight to be able to say, hey, we've had these issues, or we've got this particular issue. Here's how we're thinking about resolving this. We've got a number of solutions we're looking at. As the buyer, you'll obviously make a choice on what you want to do, but here's how this is our thinking. It's the ability to think and respond to problems, not that you've never had them.
Right. And also, I mean, there's a third alternative is not knowing how to do it and telling people that you don't know, right? And so
Yeah.
I ask my management team that sometimes when they get to a bind and I say, do you not know how to deal with this problem? Because if you don't, I'll bring someone in who does. And it's not to replace you, it's to help you. And so
Yeah.
I say that to my boards and my investors. And I say, it doesn't happen very often, but if I don't know how to do it, I'll say I don't know how to do it, and don't expect me to do it because I don't know how to do it. And so
Yeah.
You have to know your capacity. That not everyone is capable of everything. Like CEOs are not some Superman out there that know how to execute on every aspect of the organization. Sometimes you come into a corner and you may not have an answer. And I think it's important to leverage your contacts, your relationships, peers, and other people, and bring them into the equation. Ask the questions early on, not when it's collapse time, but before that, right? So, if you don't know how to do it.
Yeah, no, and I think that speaks a lot to the type of culture you obviously drive in your organizations, that you want it to be a safe enough environment where people can put their hand up and go, I don't know the answer to this, or I'm raising an issue, I don't have a solution, I'm looking for support.
Right.
I think traditionally, I've certainly seen it myself in a lot of corporate scenarios where there's a culture of people don't want to admit weaknesses or not having a solution for fear of some kind of retribution or some sort of penalty. So it's certainly not the culture I'd want to work in, and it's certainly not the sort of culture that solves problems and helps growth.
Yeah, you don't want to put your team in that situation, because if you do that, they just won't tell you the truth.
Yeah,
That's what's going to happen. They're going to keep lying to you. Like everything's great, nothing is broken, right? And so
yeah.
what I try to do is I feel like in my management companies where there's tension being built, I can feel it, and I know when something is not working, and I can feel the tension, and I break that tension by asking a very simple question: are you not able to get this done on time? And they'll say, you know
Mm.
what? I don't think I can. And my answer to that is, let's not do it then. If
Yeah.
it's not working, how about we just don't do it? Because it's not working. The other resources, you seem to be frustrated. Let's have you focus on something else. And suddenly
Yep.
that tension is gone, because now we've solved the most fundamental problem, which is we don't know how to do something, right? And so
Yeah, for sure.
you revisit that opportunity later in the cycle, or push it down, priority or something else, because most companies have multiple projects, multiple priorities, multiple products. They're not selling one thing, and it's not day over if this project doesn't get done, right? You can do something else.
Yeah.
And so, but if the attitude of management and CEO and the board is like, oh, this has to be done, otherwise, it was packing, everyone's going home, then there's going to be tension, and people are going to quit, and then they're going to be frustrated. And so,
Well, and geez, haven't we just come full circle on those early comments about Elon Musk? It's,
right,
I mean,
yeah,
honestly, I just keep reading the press about Twitter and just going, man, what is going on over there?
yeah, he's turned us into a chaotic environment, and I think it's going to hurt him and his other businesses in a big way. He's making a lot of mistakes. He's not wrong in so many ways in terms of creating a profitable business and making it
Sure.
more technology driven, and turn it into a more Web3 centric organization. That I don't disagree with, but I disagree with the tactics he's deploying. I think most CEOs would say the same. You don't just fire people like this. You don't tell them one day they need to leave, and the next day $100,000 bonus if you stick around. Like, come on, man. Like, this is not
Yeah.
cool. And these are not stupid people. These are engineers from Silicon Valley. Probably have spent a lot of time and tenure at the company, have delivered a lot of value, and you're throwing them out on the street. That's just not cool. I think it's a mistake.
Yeah, look, totally agree. It reminds me very much of some advice that a mentor of mine gave me once, is that it's not what you do, it's how you do it. And at the end of the day, I think it's a great principle to carry with us as we're going through and thinking about these decisions and different approaches we want to take. So
Yeah.
Gary, I think that's probably about all we got time for today. We've probably shot over even, so I really do appreciate you coming on and just sharing your insights with us. It's been fascinating hearing about your journey, and I know that you're going to be helping a lot of other business owners out there. So thank you so much for coming on.
Thanks, Simon. Thanks for having me.
Appreciate it. For anybody listening, if you would like more information, I'm going to put some links into the show notes for this, so that you can certainly check out Gary and on LinkedIn, as well as his various different companies. If there's any more information you'd like to know, please reach out. We're very happy to sort of join the dots here. I've just gotten so much out of this episode. I'm sure you have too. And please join us for the next episode of the Buy, Grow, Sell podcast.